Hey traders, it's Christopher Mullen from the technicaltraders.com. Want to run through the charts real quick on the SP 500, the NASDAQ, and where we are in sentiment, and a quick peek into the short-term charts of gold, bonds, and the SP 500, how they're relating to each other. Let's just jump into the daily chart here of the SP 500. Now overall, we've got this huge knee-jerk reaction bounce in price. Now I talked about this back on the website. If we go back and go 3 charts you must look at. Key points here. We need to look at the psychology of the market. Late last year, early this year, we saw the euphoric stage, everyone piling in, clear as daylight in terms of the emails, the phone calls I was getting, people just piling in near the highs there early this year. And now we've sold off. And now we're getting this complacency, this sucker's rally is what I call it. And more or less, there is so much fear getting into the buying in here, so much risk, I guess I would say, because right after this, we could go into a severe bear market. Now, everyone is blinded right now by the stimulus piling into the market, another 500 billion. We've got potential vaccine coming together. There is spring in the air, so people are starting to feel good naturally, sunlight, heat. There's all kinds of things coming together. Of course, companies starting to talk about opening up in May. So this has got investors feeling really good, and everybody's piling in right into the market, and we're getting up to this over kind of bought level. If we look, we're getting into a level here where we're going through significant consolidations, previous highs. The market could go a little bit higher, but take a look at the Fibonacci extension, or retracement here. We sold off significantly, and here we are tagging this 618 retracement level, and it's starting to put in the last 3 trading sessions. Even though the stock market has been going higher, I showed subscribers this morning how the market is doing it, how they walk price up during pre-market and post-market hours on light volume, and then as soon as the market opens, we get huge bouts of selling. Big players are unloading. We are in a distribution topping phase in the market. And of course, we broke a very significant level here. We had this previous low, we broke that, lots of damage done, and now we're recoiling up to this 618. The 618 is pretty important. I think there is potential for it to continue to push a little bit higher, maybe even pierce that. So there is still more potential upside, but take a look at this, these 3 charts that I posted over here. Now look at the 2000 market top. Did the same type of sell-off, a 40% crash when everyone saw that there were no earnings for the tech stocks, and everybody jumped out. And then we had this massive, 42% rally after that bout of selling. Well, here we are now. The virus hit, and everyone knew that it was going to be a bad quarter for earnings, so everyone sold. 32% drop. The economy is still terrible. It's going to drag out, and now the market, I did this weeks ago, now the market is getting up, and we're right up to this 618 retracement level that I talked about before. We've had a very significant rally. The market is back up here, and now we're getting to this point, this time when the market could potentially roll over and start to head down. So let's go and just take a quick look at the shorter term chart. Actually, we'll take a quick peek over at the NASDAQ. The NASDAQ has recovered really well simply because this virus event is forcing people to stay home. And that means more tech is being used, businesses running from home, conferencing, all the big tech companies which really dominate really all the indexes in terms of value percentage of the index. So they're performing really well, but the SP 500 is performing pretty much exactly like we expected. Again, look at the SP 500. We've rallied up to this 618 level, and things are starting to change. On the short-term charts, take a look at these. This is my trading system, and more or less it tells us when the market gets oversold into these lime areas, and we had oversold there, oversold short-term yesterday. So take a look at these. This is gold. This is the SP 500. This is bonds. Now, these two here are safe haven plays, these two, bonds and gold. And we're seeing gold pull back and consolidate. This is the 20-day moving average moving up. This little green hashtag you can barely see is an oversold level. So we're close to gold being oversold It's near the 20-day. It's just been consolidating, and it could have a big breakout here soon. Now look at bonds. Bonds have had a nice run up. They're consolidating. It's tagging the 20-day. It's also becoming oversold based on all kinds of intermarket analysis, momentum, a lot of different things. Tagged again yesterday, having a little bit of a bounce. Looks primed and ready for a breakout in another run. Now look at the SP 500. This red hashtag means the market is overbought. We've gone from oversold to overbought, and we're pretty extended away from the 20-day moving average. This could very easily pull back, sell off while the money moves into the safe havens, and we start to see bonds and gold move higher. So that's kind of where we are on the short-term chart. Now, these are just the 30-minute chart. So each one of these little sections here is one day. 13 30-minute bars. So we get to see the short-term price action. Overall, we're looking for the safe havens to stabilize and start to move higher. Equities market showing signs of distribution, even though it's been moving up. I went through this with members. There's some really detailed information about how the market is distributing shares, selling huge amounts of stocks, even though the price is moving higher. And of course, the market loves to bridge above resistance levels. It'll gap. We see a gap. We had another big gap. We had another big gap. And these gaps in the way that the market makers trade, and these big players, they can allow the market to do these and still be selling huge amounts of shares as the price goes up. And that's what they want to do. They're trying to get out. And the fact that bonds are holding up, take a look at the chart of bonds. Here's TLT. Now, bonds is a huge market, and for them to continue to move higher while the stock market is rallying, the bonds tends to know more about what's going on in the future than the stock market does. So when we saw this big pattern right here unfolding, whoops, wrong tool. We saw this trend line broken. We got into bonds. We played the move up right into this area, hit our Fibonacci, 100% measured move Fibonacci target based off the low, the high, the low, gave us this target. It ended up having a blow off top and then reversing 20%. But we nailed this move, and the stock market was rallying during this time. The stock market was rallying higher, bonds were slowly moving higher, or they were actually picking up speed, and we're doing the same thing now. The stock market's moving higher, bonds are moving higher, and it's just a matter of time, I think, before we see the tide change in the stock market. It collapses, and bonds could really continue to pick up speed and break out and go parabolic once again. And who knows where bond prices are going to go, where yields are going to go if this takes off much higher. I mean, we're looking at zero negative rates at the way things are going. So anyways, there's some interesting views on the SP 500 and the safe havens going forward. Take care. Bye-bye.